Hello and welcome to Financial Express. I'm Shaleen Agrawal. We have with us Sahil Kapoor, Head of Products at DSP Mutual Fund. Sahil, thank you for being with us.
Thank you, Shaleen. Thank you for having me.
Sahil, is India right now better placed than other developed and developing nations, especially amid slowdown and recession fears?
So Indian economy per se is better placed. There is no doubt about it. I think we are probably doing better than the peer set at least. Most emerging markets are struggling with not only inflation problems plus capital outflow problems, but also with domestic growth slowdown. I think this is something sort of a three-pronged problem that these peer set is facing, the emerging market peer set. India, on the other hand, is facing lesser issues. I think domestically inflation has been under better control in comparison to other emerging market peers. Secondly, our growth has been much more steady, much more stable, less volatile in recent past. And probably it has picked up pace in the last 2 quarters. So again, which is quite positive for us. So on the whole, if you look at the biggest problem that we are witnessing right now domestically is from the balance of payment. That means we are spending a lot more dollars than we have, which is becoming a pain point for us and which is also a source of risk for us. But if you look at it in totality, we are still better off in comparison to a number of peers. So I think we are the what Alan Greenspan called just a few weeks ago, we are the least dirty blue shirt. I think that is what we are.
Is that the reason enough for this exuberance in the markets that we have been seeing in the last few weeks?
So I think we have to separate markets and economy. When you talk about markets, we have to focus on what is driving the market. And largely, there are two clear indications. One is from earnings growth. So if you look at the earnings growth cycle, so in the last 3 years, if you compare it to, let's say, the quarter just before COVID, and you get to the numbers up until last quarter, if you look at India earning growth, it has been about 19% CAGR. Okay. And if you look at India's nominal GDP, it has been close to about 12-13% CAGR in that period. But when you look at the real GDP growth, it has been just 2.5%. So this is the story of how things have panned out. The economy has done not so great, but when you look at the nominal numbers, that means you add the price numbers, it has done well. But when you look at the corporate picture, the profitability has improved tremendously. And a large part of that improvement has flown through different sectors at different point in time. So initially it was, pharmaceuticals and healthcare sector. Then IT took over as, we went into lockdowns and other, and FMCG played out with big numbers. Then eventually you had metals, which had the metals and oil and gas, which showed up in inflation numbers. And now in the last 2-3 quarters, we are witnessing a revival of BFSI, of auto consumption, where these numbers have started to come back. So it's been a story in last 3 years where Nifty earnings growth has done quite well. And that is the reason why market has done well. At the same time, if you see last about 18 months, we have seen our PE has derated. So if you look at the correct numbers over the last 18 months, our interest costs, for example, if you take a AAA corporate bond 3-year maturity yield, it has gone up by about 300 basis points. And the average PE multiple on Nifty has gone down from about 28 to 21, right? So our valuations have shrunk, earnings have caught up. And I think this is one of the reasons why India has performed well, because earnings have been the mainstay.
I'll talk about valuations in a little bit more detail later. About earnings, in the second quarter results, there was some positive commentary about margins. Any comment on that?
So in December last year, in one of my publications, I put forth a chart which showed that because price pressures, specifically the input price pressures, are rising, it will compromise the profitability of commodity users, and where input prices are a very large component, and which has played out over the last 3 quarters. And recently, what we've seen is that a number of things which are directly related to input prices, for example, commodity prices, for example, a number of supply side issues, freight rates, all of them have declined over time. And this decline probably will start reflecting in better margins. So to divide your margin question into 2 parts, I think the story of last, let's say, 8 quarters is a very sharp improvement in top line. Okay. And that sharp improvement in top line happened because there was a lot of inflation. So it played out. So demand plus inflation caused a huge jump in sales. At the same time, when inflation became entrenched, margins got compromised. Okay. Now what we are saying is that slowly and steadily, inflation is coming down. So if you pay attention to WPI, which is the wholesale price index, it has gone down from it used to be at about 14% for a number of months. Latest reading is at about 8.5%. And I think it is heading towards zero if I were to make that assessment.
That's a
And
very
if
bold
that is the
statement.
case, if that is the case, then probably we'll see, margins make a comeback. But at the same time, sales will also take a hit because this is chicken and egg. They go together. So eventually, I think margins will see an improvement over time, over the next few quarters, largely because input prices are coming down.
And what about immediate outlook on margins in the current quarter, the upcoming results?
I think it's a very, very mixed bag for various sectors. We see there is a good margin improvement which will happen for, let's say, auto ancillary, where commodity users will continue to see improvement in margins. Secondly, we are also witnessing slight margin improvement in FMCG and staples, right? Possibility of margin improvements in exporters which use a lot of freight. These are the areas where margin improvements will happen. On the other hand, IT, which has maybe in the last quarter said that their margins may have bottomed out, but the recovery will take time, and which is a very large part of the market. The other large part of the market is BFSI, where NIMs are probably at the best. The quarterly results that we had, I think, were one of the best in the last 10 years. So I'm not sure whether this best quarter will continue to show up in the next quarter. So maybe we'll have a little less best quarter, not so great, but eventually it will still be very good. But so a large part of market, IT, BFSI, will see some deterioration. The other part, which will probably see input price pressures coming down, will see improvement. So it's a mixed bag. But I think on the whole, once we start pushing out of FY23 into FY24, we'll probably see better margin picture. That means improvement in margins at the overall level.
You spoke about valuation derating from 28 to about 21 on Nifty. Is that comfortable enough, or is it still high?
I think it is still high. My guess is that pre-COVID we used to be at about 18 times, and I remember I was going through some of my old notes in FY14 and FY15 when market was trading at about 16.5 times 1 year forward and about 18 times trailing earnings. I was writing that we are slightly above average, right? Even at that time. So if you remove the recency bias, of course, we are above average valuations right now. And with the rally that we've seen in the last 2 months, valuations have gone up a little bit. And so I think in the next few quarters and years, we will have better improvement in earnings. But at the same time, it will be challenging for markets to trade at same valuation. It's going to be a challenge. So slowly and steadily, you will see that valuations will drift lower, maybe by another 100, 200 basis points. And that will be the comfort zone. But this doesn't happen overnight. This doesn't happen in a month. It's a very slow process. Market takes its own time to adjust these things. And I think that adjustment will continue.
What will happen faster, the correction in the markets for the valuations to be at comfortable levels, or the catch up in the earnings for that?
Shaleen, it's anybody's guess. It's my guess is as good as yours. I don't know. I have no idea. There is no way to predict that. But my guess is that earnings catch up will continue. Earnings growth is a slow process. It happens every quarter. Howsoever we would like to see a earnings change in a day, it doesn't happen, right? It takes quarters and quarters of things to change. So earnings will, of course, improve slowly. But if there is market volatility, for example, an uncertain event that we don't know today, if that could crash the market because of any reason, then that adjustment will happen much faster, right? So you really don't know what will happen with the market. But yeah, with earnings, there is some fair bit of possibility that the improvement and the trend will continue.
So just last question on this point. Mathematically, 100 to 200 bips correction in the valuation. That's what you said, right? 100 to 200.
That's right.
Mathematically, how much of correction is needed for Nifty for that? How many
So
points?
roughly, so if you just take, let's say 20 ka PE, right? And if you say that there is going to be a 5% correction in valuation, right? Which means 1. So that means 100 basis points. So if you're talking about 200 basis points, you are talking about 10% correction in prices to at the same level of earnings. So I think that is how mathematically you look at it. So let's say if earnings rise by 10%, and if valuation has to correct by 10%, so market will have just about a 5% movement.
Which brings me to my next point now. Yeah. What are the risks that one must watch out for the markets in the near term now, and how to hedge for those risks?
Sure. So first thing is that the largest source of risk is known right now. Okay, and markets seldom move on known risk, but I will still try to put forth what that risk is. So one of the largest risk is the one emanating from balance of payments.
Sure.
So if you look at last 6 months, from in FY23, we've been running about $25 billion of monthly trade deficit, which is a very high number. If you annualize it, mathematically, it goes to $300 billion, which is, we haven't done that number ever. On a market cap, on a GDP basis, this number is about 8% of GDP, 8.5% of GDP, which is very large. The worst years that we had in last 40 years, they were at 10%, 10.5%. So we are very close to that number. So this, I think, is a large source of risk. And why is it a large source of risk? Because right now we are having a very volatile regime in capital flows. Our FI flows are not very consistent. They are, they are going up and down. Earlier there were large outflows, then we had large inflows. So it's very volatile. So when you look at the trade flows, they are particularly negative, right? And very large negative trade flows. And when domestic monetary policy is tight, that means RBI is raising interest rates and trying to stabilize the interest rate regime, very strong capital outflows or trade outflows, they can cause a sharp liquidity reduction in the domestic market, and which is what has happened over time. The only saving grace is that we entered this sort of a crisis period in trade, let's say in trade deficit, with a very large liquidity surplus in the banking sector. We had about 8.5 lakh crores of liquidity surplus. So we've been able to tide over this phase relatively better. But the risk that I said is that if this continues for another year, okay, we will not be able to tide over it. So I think that is the biggest source of risk. And the most important anchor to remember and to measure this risk is crude oil prices. So if oil prices continue to remain above $95, $90, or let's say $100 in the next 12 months, I think we'll have a huge source of risk. And the only solution that we'll be left with, at least one of the solutions, is to slow down our economy, right? To reduce imports of oil and gas, and that will probably cause this situation to balance out. So I think this is the large risk. How to hedge it is a very tough question because you don't have...
Sorry, before that, you said that we will, if that risk remains for next 1 year, we will not be able to tide over it. What does that statement mean?
That statement means that we'll have to make some painful adjustments. And one of them, as I said, slow down the economy by raising interest rates, trying to protect our currency. Those two steps will have to be taken, right?
What happens if we don't?
Then currency will weaken appreciably. And if that happens, inflation will go out of hand, right? And these two eventually will cause economic slowdown. So these are the external risks on which we don't have any control, right? So unfortunately, India pays about 7.5% as energy bill overseas, on which we don't have any control. We are price takers. So the only thing that we can do is we can control some of these factors and help and tide through these phases.
You're talking about investors. How should investors play out this risk or prepare for that risk going forward?
So largely, when you look at this risk, I am using this risk as a source of potential return in the future. I think the market has probably priced in a lot more negatives than positives. My base case is that oil prices are headed lower, probably towards 60, where I told you that WTI is headed towards 0. These are my expectations, of course, not predictions. I think they can, of course, be wrong. So my sense is all the hypotheses around risk which I built will probably play out positively for India. But if it doesn't, and if it plays out the other way, then the only way to hedge yourself is probably to remain in the short end of the bond yield, right? That curve will continue to help you tide over this kind of phase. Second is probably buy some of the things which will benefit from this dynamics. That means if there are higher oil prices, probably companies which are into energy sector, whether it is coal or oil and gas, they will continue to benefit. Not the marketing companies, but the upstream companies. Eventually, they will benefit from this, and that is the only hedge that is possible here. The other is to have a better asset allocation mechanism where you have debt as a component of your portfolio. So, in short, you should be a little more risk averse if this if this has to play out.
And we are talking about next 2 to 3 years now.
Particularly the next 12 months. I don't think next 2 to 3 years. Sure. This is the risk that you asked me, that this may not be the base case. I think my base case is much more positive.
Please explain that.
So I think domestically, we are probably going to see better earnings growth. And a lot of participants are not appreciating that earnings growth in India has probably improved, at least for the next 3 to 5 years. There is a what do you call apprehension, or people don't appreciate that there will be 12 to 15% earnings growth, and the reason is that we have not been able to do it pre-COVID over the last 7-8 years. And when you break up earnings, let's say if you take 100 rupees, about 38 to 40% of India's market cap is just BFSI, banking and financial services. Lenders per se are about 33-34%. That component between let's take the worst years, between FY14 and FY19, their earnings CAGR was about 1.1%, an absolutely worst period. And the earnings CAGR for the overall market was about 4.5%. And if you removed BFSI, the earnings CAGR rose to about 8.5%, right? In the last 2-3 years, what we've seen is that when you look at lenders, their balance sheets have improved. The credit quality has improved. That means asset quality has improved, and credit growth has come back. So if you take these 3 parameters, and if you just did, I'm not going to details, but if you just did the numbers, for BFSI to do 15% plus annual CAGR in terms of profits over the next 3 years, I don't think it will be tough. That should be the base case. And if 38 to 40% of your market cap is going to do that kind of earnings, plus if you see IT earnings, which are probably more stable in the longer term, right? Secondly, a revival in healthcare, where earnings are probably coming back as per our estimates, and the other large component, which is industrials, where again earnings are making a very strong comeback, right? So if you put all these sectors together, my estimate is that we'll be able to do between 12 to 15% earnings growth over the next 3 years, which translates into similar returns for the market, give and take the valuation discount that will occur, which I spoke about earlier. So even if you remove that, I think we'll be able to give a good, healthy equity performance of between 12 to 15% over the next 3 years. So I think that is a base case that we should work with.
No immediate triggers seen for an immediate correction for us to investors to enter at better levels.
Shaleen, there are always triggers. I mean, we don't know what will happen in the short term.
I'll tell you why I'm asking this. A decent rally has happened in the last few weeks, actually, and investors are wondering, have they missed that, or can they get a better opportunity anytime soon, especially in the run up to budget? So that's where I'm coming from.
So Shaleen, in the month of September, we actually wrote a report when markets were at 18,000 Nifty levels. We said that if markets were to come down to 16,500 and 17,000 range, we gave a set of reasons why you should be upping your equity exposure at that point in time. So I will give you a model on which how to think about it. So let's say in the year 2024, Nifty will do 1,000 rupees EPS. Nobody knows which month. It could be March, it could be September, I don't know. My estimate is that by the time we reach 2024, FY24 and FY25, somewhere in between, we'll do 1,000 rupee EPS. On a trailing basis, Nifty has not closed any financial year in the last 10 years below 20 times trailing multiple. That means in the next 18 months, Nifty is probably going to hit 20,000, right? And if you can get a 20% plus CAGR return from whatever level, that level right now rests at about 17,000 or lower, right? So at about 17,000 nearby, your return profile improves tremendously, and that is where you should up your equity allocation. What can cause the market to correct? Probably, I think, deteriorating data in global economy. That is one source of risk. I think there are clear indications that US economy is slowing down. Fed is orchestrating a slowdown across the board, and that will probably hit some markets in the near future. If that is the case, then probably we should get a dip to add equity exposure. But I don't know whether you should continue to wait for it. We have been a proponent of systematically doing your investments over time. So I'm not sure how the marginal investor will benefit from a dip. But yes, if you have place, you should add equity exposure if those levels were to come.
I want to talk a minute about foreign flows. Foreign flows are now back after being negative for a few months earlier in the year. And domestic flows are very resilient.
Right.
Is it only the liquidity which is driving domestic flows and foreign flows, or are there any other factors?
So if you look closely, the interesting thing is that from a FPI angle, there hasn't been any change for flows to restart, right? The Fed is still tightening liquidity, right? And because of that tightness, there has been a huge change globally. So I don't know whether we have time for this, but I'll tell you very briefly. So US is the source of very large FI flows globally because that is the mother market globally, right? Capital flows have been reluctant to flow out of US largely because of two reasons. One is that growth has been slowing globally, right? And secondly, US central bank has been squeezing liquidity, okay, which is causing capital to go more towards safety rather than anything else. Second important fact is that trade flows have changed. So earlier, what was the case that very large trade surplus countries like Germany, South Korea, China, Taiwan, these countries have turned, either net importers. That means their export revenues have vanished. And why that is the case? Because they have become very large importers, right? So Eurozone in totality is importing so much gas from US that dollars are flowing into the US rather than flowing out of US. And this is causing a very large liquidity squeeze globally. So there is particularly no reason for us to believe that very large capital flows should have come. That should have been the case. But what we saw, there were a few triggers which indicated that the intensity of outflow will stop. And we highlighted this way back in July, saying that in the second half of 22, there is a possibility that outflows will halt or probably inflows will start, either of the two. So in totality, we haven't got very large inflows. If you look at the second half up until now, we have got some inflows, not very large. But in totality, I think there is a possibility that this will improve going ahead. And why do I say that? A, the possibility that incrementally the US Fed will be as hawkish as it has been over the last 9 months is less. So inflation pivot it's already achieved. I think we wrote a report in July and titled it very catchily, The Coming Collapse of Inflation and How to Benefit from It. And we clearly highlighted that the inflation numbers have peaked in July, and they did. And we expected them to decelerate from November onwards. And we believe that in the next few months, you will see sharper cuts to global inflation numbers. And if that is the case, then most likely US central bank and other important central banks will find it very tough to remain hawkish. And that will cause this risk of sentiment to abate and flows to make a comeback. So global flows probably will make a comeback. Domestically, I think it's largely a financialization of saving which has played out over time, and that has helped equity flows. Plus, secondly, I think the way in which domestic flows are getting built, which is a systematic investment plan, the SIP money, it is sticky in nature because of a behavioral kink. It doesn't have a lot to do with people's expectation of market levels or valuations or earnings. I think it is a behavioral kink which is causing this money to be sticky. And we don't have any evidence right now that this is changing or it will change or it will peak out soon. I think this trend is continuing and it will continue to support the market.
Uh, as a product manager in a fund house, have you seen any behavioral change from investors, from retail investors especially, less panic reactions, stuff like that?
So people who have SIPs, I think they probably will have less panic reactions. Secondly, people who don't watch markets on a daily basis and are focused more on their profession and occupation, I think they don't have panic attacks. People who are too glued to the screen, I think they are bound to have more panic attacks. And I think we should divide investors into two categories. One, those who don't belong to the financial sector for their employment. I think they don't even care so much about where the Nifty was yesterday and today, or is there a panic in the market. So for them, if they have an SIP route of investing, I think they are sticky in nature. They continue to be sticky. The others who are in the financial markets and who watch the market too much, I think they are bound to react, right? And that causes more reactions. At the end of the day, all investors are similar. Their reactions are similar. So it's tough to paint everybody with the same brush and say that the whole market has become smart. I think it is the instrument that a large pool of investors are using, which is probably causing this behavioral kink to occur. On the whole, I don't think we have become smarter or better investors over time. I think it is the strategy which is working.
Well, whatever kind of investor you are, I would urge watch this conversation. This is very useful for everyone. One of the let it be the last question for the day.
Yeah.
You mentioned about asset allocation. What would be your ideal asset allocation for a moderately risk averse investor for the short term, next 3 years?
So when we talk about, let's say, moderate investor or risk oriented investor, then I would assume that the base case for allocation is about 50% equity. Moderate guys shouldn't go above that level, which is enough for them. I think right now they should be a little overweight with slight favor towards mid and small cap stocks. So probably a 60% equity allocation with a tilt of, let's say, 40 towards large cap and rest 20 towards mid and small cap. I think that is where the equity allocation should be. They should have maybe about 5% or 10% allocation depending on their overall strategy to gold or probably gold mining equities as a theme. Probably because you are moderate, a 5% allocation is more logical. The rest 35%, if it goes to fixed income on the whole, I think you should hold about 5% in short-term or liquid funds because returns are very, very good right now. Probably put another 10% in the belly of the curve, which is between, let's say, 4 to 6 years maturity, where yields are attractive, and probably try and play duration for the rest of 10%, right? And that is where some play is available right now. The longer term bonds are becoming attractive basis because our inflation is going down. So not taking a very large bet on rates, but still exposing your portfolio maybe to the extent of 10% on duration. I think this overall strategy should make sense.
Sure. I was going to ask you Nifty target. You already said that. One final question. Do you have any view on Bank Nifty?
So interestingly, Shaleen, last year or at the beginning of this year, I wrote a thread which spoke about Bank Nifty. At the time, Bank Nifty was about 32,000 with 3-year returns of 0%. So 2-3 things. One, if you look at Bank Nifty and compare it to Nifty, the valuations on a relative basis are still below average, even after the outperformance of last 1 year. Second thing, if you compare the inferior part of banking in India in terms of their profitability and business performance over the last few years, which is the PSU banks, their relative valuation, that means if you were to do a long-term comparison between price to book of PSU banks to the Bank Nifty itself, it has gone up from about a ratio of about 20% to 40%. This is the highest that we've seen in the last 7 years, and rightly so, because business performance has improved, right? So Bank Nifty on the overall numbers is I think has three benefits. One, asset quality has improved tremendously. Our NNPA of the top 5 bank is now 60 bips. I think this is the lowest number that we have seen since the data is available. We don't have data going back 30 years. I have that data. It's the lowest up until now. Credit growth has improved to about 18% YOY. I think it will settle down at 15 or lower, which is a very healthy number. And third, banks' balance sheets are very, very good. So on the whole, the thread which I mentioned, I wrote, I think I was expecting a large jump in the BFSI sector and probably, Bank Nifty hitting the half century mark. I think it is set to go in that direction.
In how much time?
That I don't know. When I wrote the thread, I expected it to happen over a 18 to 24 months period. I think about 8 months have passed.
Sure. We've just approached half an hour of this conversation, Sahil. We'll end it here. And
Sure.
there are several interesting points from this which we can take forward in next conversations.
Sure, Shaleen. Thank you for having me, and I hope I'll be able to add value in the future.
Definitely. Sahil Kapoor, thank you so much for being with us today again.
Thank you. Thanks a lot.